I am Marcus Heeland, a managing director in KPMG's national tax practice, and I'm joined by Chris Wilson, a director with KPMG UK that is currently seconded to the US and is on the UK desk. In this video, we'll be talking about the impact of Pillar 2 on US-based multinationals. As a reminder, with a few exceptions, every multinationally operating business with at least 750 million euro of consolidated revenue is within the scope of Pillar 2. And there are a few thousand US companies that meet that threshold, and so Pillar 2 has wide applicability. In terms of the implementation of these rules, it was just today, December 16th, where the EU is able to get unanimity on a directive. And so Pillar 2 will now be implemented in the EU, with the IIR coming into effect from 2024 and the UTPR coming into effect in 2025. With the EU now moving ahead, it seems more likely that other jurisdictions will follow suit. However, implementation is less certain in the United States. Even with non-participation by the US companies will still be exposed to the Pillar 2 rules implemented in other jurisdictions in which the company has operations, which brings with it potential financial impacts in terms of cash tax and effective tax rate. But perhaps just as importantly, it'll bring very significant incremental compliance and administrative burdens. Chris, before we get too far, can you provide an overview of how Pillar 2 operates, as not everyone may be familiar with the regime?
Sure, thanks, Marcus. Pillar 2, at its simplest, seeks to introduce an effective minimum corporate tax rate globally. Over 130 OECD members agreed that the level of minimum tax should be 15%, and as Marcus has outlined, we've already seen countries start to take steps towards implementation. So what is the structure of the rules? Well, the rules take a top-down approach. The income inclusion rule, shown on the left of this slide, requires the ultimate parent entity, or UPE, to pay a top-up tax on its proportionate share of the income of any low-tax subsidiary. The tax is a top-up amount required to bring the overall tax on the profits of a jurisdiction up to the minimum 15% effective tax rate, or ETR. The UPE is given priority for applying the income inclusion rule. However, if an in-scope group's UPE is located in a jurisdiction that has not implemented the IIR, then responsibility for applying the income inclusion rule falls on the next subsidiary down the chain of ownership. So, if a US headquartered group has an intermediate holding company, say in the UK, and the US does not implement the income inclusion rule, but the UK does, it would be the UK intermediate holding company that would have an income inclusion to bring the undertaxed profits in a third jurisdiction up to that 15% minimum threshold. But what about a situation where neither the UPE nor any intermediate holding company is subject to the income inclusion rule, you might ask? Well, that's where the second rule, shown on the right of this slide, is designed to kick in. The undertaxed profits rule, or the UTPR, serves as a backstop to the income inclusion rule and is aimed at dealing at cases in which the IIR is not applied. This rule effectively allocates the taxing rights over any undertaxed income to jurisdictions that implement Pillar 2. So, if an in-scope group has one or more subsidiaries located in a jurisdiction that implements the UTPR, these subsidiaries jurisdiction would effectively seek to tax the undertaxed income via the UTPR. This would likely be achieved by way of denying deductions. We highlight on this slide also the subject to tax rule, but I want to speak about the Qualified Domestic Minimum Top-Up Tax, or the catchy acronym QDMTT. Under the OECD model rules, the amount of the top-up tax payable under the income inclusion rule and the undertaxed profits rule are net of any QDMTT that is paid. This ensures that source countries retain the primary right to tax profits sourced in their territory at the 15% rate, if they choose to do so. QDMTTs will effectively calculate the ETR in a jurisdiction under the Pillar 2 rules. More on that in just a moment. And where that ETR is below 15%, these domestic minimum taxes will effectively top up the tax due to be paid to reach the 15% rate. Based on the global reaction to date, we expect that it will be these domestic minimum taxes that do most of the work in achieving minimum taxation. Accordingly, actually in some ways, the structure of the rules may very well be bottom up rather than top down. On the next slide, we wanted to give you a very brief overview of how the Pillar 2 calculation actually works. Now, this is going to be a really simplified run through the 7 steps we show here, but hopefully it gives you an overview of how the Pillar 2 rules will work in practice in achieving the 15% minimum tax. The first step of the calculation is determining income subject to Pillar 2 on a jurisdictional basis. We'll refer to this as globe income. The starting point in most cases will be the income or loss that is used for preparing the consolidated financial statements of the ultimate parent entity. However, this net income or loss will be adjusted to eliminate a number of common book-to-tax differences. For example, excluding dividends and equity gains or losses, thereby eliminating double counting of previously taxed income in line with the participation exemptions that apply in many jurisdictions. Once we've determined the jurisdictional globe income, we move to step 2 and determine what the covered taxes are in that same jurisdiction. Again, the starting point for the computation of covered taxes will be the current income tax expense accrued for the financial statements. But as with the globe income calculation, adjustments will be made. Perhaps the most famous of these adjustments is in relation to tax credits. Tax credits which are not qualified refundable tax credits will be treated as a reduction in covered taxes in the year such credits are granted. An adjustment will also be made to cover taxes by way of a deferred tax adjustment to make temporary differences and prior year losses, take those into account for Pillar 2 purposes. Marcus will give us a couple of examples in just a moment. At step 3, we do some maths. We calculate the ETR of each jurisdiction by dividing the covered tax amount we just calculated by the globe income we determined at step 1. At step 4, we identify if any top-up tax will be due. If the ETR calculated at step 3 is 15% or higher, we can effectively stop. However, if the ETR is less than 15%, we know that top-up tax will be due in respect to this jurisdiction. Now, the top-up tax percentage will not apply to all profits arising in the jurisdiction. Rather, it will only apply to what are described as excess profits. Now, what are excess profits? Well, this is determined here at step 5, where the globe income we calculated at step 1 will be reduced by a substance carve-out. This carve-out is intended to represent a fixed return for substantive activities undertaken in a jurisdiction, and it has two components, a payroll component and a tangible asset component. Now, we're nearly at the end of the calculation at this point. We know the top-up tax percentage, and after applying the substance carve-out to globe income, we now know the excess profit. By multiplying the two together at step 6, we determine a top-up tax that will be due in relation to the low-tax jurisdiction. At step 7, we determine the mechanism by which this top-up tax will be reported and paid. And as we discussed on the previous slide, this may be by way of a domestic top-up tax, the income inclusion rule, or the undertax profits rule. And there we have it. That's a high-level and simplified run-through the steps by which Pillar 2 will work in practice. As we've seen, the key is that effectively the calculations are done on a jurisdictional basis to identify jurisdictions with low tax profits. There is no cross-border blending under Pillar 2. So Marcus, perhaps now that we've gone through the calculation, you can bring this to life with a few examples.
Sure. I've picked 3 examples to share here, which I think illustrate 2 broader points. The first is the Pillar 2 rules are immensely complicated, primarily as a result of being a sort of mashup of tax rules and financial accounting rules. And in certain places, the intersection of the tax with the accounting leads to non-intuitive outcomes. Such outcomes can only be detected through quantitative modeling, which I think most companies are now in the process of completing. The second point, and this relates to the first, which is despite having a 21% corporate income tax rate, there are a number of instances in which the income earned in the United States can be viewed as being taxed less than 15% under Pillar 2 math. And this will lead to additional tax being paid in other countries via the undertax profits rule. And so if we go to the next slide in our first example, here we have a US parent with 2 foreign subsidiaries, ACO and BCO. The assumption is that country A and B have both implemented the undertax profits rule. And so we need to check to see if the Pillar 2 effective tax rate in the US is at or above 15%. In year 1, USP receives a royalty of 100 from ACO that is subject to 20 of withholding tax. USP has a $50 overall domestic loss, and so it has net foreign source income of 50, taking into account the royalty. That 50 of foreign source income is subject to a pre-credit US tax of 10.5. USP then takes a foreign tax credit of 10.5 with the 9.5 of excess foreign tax credits being carried forward. In year 2, USP has 100 of US source income, of which 50 is subject to the ODL recapture rule as foreign source income. USP will then have 9.5 of foreign tax credit carry forward to take against its pre-credit US tax of 21, resulting in net US tax in year 2 of 11.5. Moving to the analysis, the issue is USP is going to run into here is Article 4.41E in the OECD model rules, which essentially denies deferred tax assets related to the generation and use of tax credits. That has the effect of overstating the ETR in year 1 and understating the ETR in year 2. In particular, in year 2, USP has an 11.5% Pillar 2 effective tax rate. And the reason for that is because USP cannot claim the deferred tax expense related to the utilization of the foreign tax credit. So basically, all we get to count is the current tax expense of 11.5 on financial income of 100, and so top-up tax is due. There has been some advocacy around the rule that is causing this problem, both with respect to how it should be interpreted on transition into the Pillar 2 regime, as well as permanently in respect of overall domestic loss situations. And we'll see where the OECD comes out on this as part of the implementation framework once it is released. Moving to the second example, here we have USP again with foreign subs also in country A and country B. USP has 100 of financial income subject to pre-credit US tax of 21. USP is also entitled to a non-refundable credit of 21. And so USP pays 0 tax as a result of that credit. And so a 15% top-up tax is due here under the undertaxed profits rule. This is clearly an extreme example, but it is really making the point that most US credits are non-refundable, including, for example, R&D. And if those credits are material enough, and when they're combined with other incentives, for example, material FDII deductions, that can cause US effective tax rates less than 15%. I noted that the credit in question here was non-refundable. And the reason that matters is because if a credit is refundable within 4 years, then under the Pillar 2 framework, it is treated as an increase to income, not a reduction to cover tax. And that's a good thing because it results in a higher effective tax rate. Most US credits, including the R&D credit, are not refundable. And so that favorable above the line treatment is unavailable for most US credits. However, several of the credits that were provided in the Inflation Reduction Act are transferable. And transferable credits seem economically similar to refundable credits. And so I think there's good logic that transferable credits should be treated as refundable credits under the Pillar 2 framework. But here, too, we'll have to see where the OECD comes down on that as part of the forthcoming implementation framework. And then finally, the text in this slide makes reference to equity method. And so just briefly on that, certain US credits, including, for example, affordable housing and some energy credits, those are often structured via partnership arrangements, partnership entities that are accounted for under the equity method of accounting or a similar accounting method. And the OECD's rule excludes the income or loss associated with equity method accounted entities. I understand the OECD will also be releasing guidance on how credits from these types of entities should be accounted for. And here the OECD has already shown its hand in some ways in public remarks, noting that since the income or loss is excluded, so should any tax consequences. But it's unclear if that result is acceptable to the full inclusive framework. So again, let's see what the implementation framework says. Finally, the third example deals with another special rule, this time the treatment of deferred tax liabilities. The same characters here as the prior two examples. We have USP, ACO, and BCO. USP has 100 of financial income. USP is assumed to have a book-to-tax difference from, in this case, the development of software of 50, and so taxable income of 50. USP is subject to an assumed 15% corporate income tax rate, so that results in 7.5 of current tax expense. The company would also record a deferred tax liability of 7.5 related to that $50 timing difference. It is assumed that timing difference, for purposes of this example at least, does not reverse until year 10. The analysis here is that USP is going to run into Article 4.4.4 that essentially takes away the 7.5 of deferred tax, causing a 7.5% ETR and therefore top-up tax. The test for purposes of the article in question here is that with the exception of certain deferred tax liabilities that are on an angel list, all DTLs must reverse within 5 years, otherwise they are disregarded. I see this rule most commonly applying in the case of goodwill amortization, where there's a tax deduction under Section 197, but no book expense. The DTL ends up being disregarded under the Pillar 2 framework, which can cause the US effective tax rate to drop, causing top-up tax if it's material enough. So with that, Chris, maybe I'll pass it back to you to go through some other considerations for US-based multinationals.
So let's quickly talk through some of these issues through a very simplified structure for a US multinational group. Our working assumption, as at the time of recording, is that the US will not implement a qualifying income inclusion rule. So what will the interaction be with respect to the existing GILTI regime? Well, point one is that GILTI is not a domestic minimum tax. Accordingly, if the effective tax rate of the US parent does not meet the 15% threshold, subsidiaries could seek to tax the effectively undertaxed profits under the UTPR. If they did so, will this tax be creditable for US purposes? As we move down the charts, groups will need to determine whether their intermediate holding companies are subject to income inclusion rules. If so, that holding company will need to look down to the subsidiaries, determine if any are undertaxed. But when doing so, will they take into account any GILTI tax paid at the UPE level? If they do, how will that GILTI tax be allocated to the subsidiaries? The UK has made some helpful comments in respect of this, but for groups subject to the corporate alternative minimum tax, the same question will apply. Will that be taken into account? Some groups with multiple intermediate holding companies in multiple jurisdictions with IIRs may wish to consider rationalising their structures to reduce the burden of Pillar 2 by dealing with a single IIR rather than multiple. Let's continue down the structure. Do the source countries implement domestic minimum taxes? If so, will they take into account GILTI tax which is paid in the US? If there is no domestic minimum tax and there is a low tax jurisdiction in a group, subsidiaries elsewhere may seek to tax those undertaxed profits under the UTPR. Again, we wonder whether such taxes will be creditable in the US. Groups without an intermediate holding company may wish to consider the desirability of having an entity in an IIR jurisdiction to deal with a single IIR rather than multiple UTPRs. However, the timing of UTPR implementation may factor into such considerations. As I've indicated, groups need to start looking at their structures to assess the impact of Pillar 2. As this slide indicates, the interactions for US headquarter groups may be particularly complex. Marcus, I briefly mentioned US book minimum tax. Perhaps you can give us a quick comparison between this and Pillar 2.
Well, if the question is how does the Pillar 2 rules interact with the newly enacted US corporate alternative minimum tax, I think the short answer is that they're just completely different regimes. So I wouldn't even think of them as being related. A few points to keep in mind would be first, and I've already alluded to this, is that the US alternative minimum tax is not anticipated to be a qualifying income inclusion rule or a qualified domestic minimum top-up tax. And so it does not bring the United States into alignment with the agreement under Pillar 2. The second point is that even if a taxpayer is within the scope of the US corporate alternative minimum tax and even paying tax under that AMT, it could still be subject to additional tax under Pillar 2. And that is because, among other things, different treatment of general business credits and blending with foreign branches. The third point is that I do expect that any tax that's paid under the US AMT would be treated as a cover tax for Pillar 2 purposes, and therefore should be included in the Pillar 2 numerator. To the extent the tax is triggered by low tax US income, I would assume it would be a US cover tax for Pillar 2 purposes. And if it's being triggered by low tax foreign income, I would expect it to be treated as a foreign cover tax. But here too, I think the OECD needs to issue guidance to help companies make those determinations. So Chris, I think that's a high level overview of the mainly differences between those two regimes, but how the two would coordinate with one another.
That's great. Thank you, Marcus. And that concludes this video. Marcus and I would like to thank you for taking the time to join us today. And we hope you found this video informative. This is one of a series of recordings discussing global tax reform. So if you found this video interesting, you may want to check out one of our other recordings. If you have any questions, please feel free to reach out to Marcus, myself, or your usual KPMG contact. Thank you and goodbye.